On April 20th, 2020, the price of a barrel of crude oil went negative. Not zero, negative. Minus $37.63. You could have been paid to take oil off someone's hands. Producers panicked. Traders lost millions in minutes. And the cause of it all was one thing: a futures contract nobody wanted to be holding when it expired the next morning. By the end of this video, you'll know exactly why that happened and how futures actually work, step by step, all the way to opening your first position on a platform. Let's get into it. What is a futures contract? A futures contract is simply a legal agreement to buy or sell something at a price you fix today on a date you fix today. The asset, the price, and the date all lock in the moment you sign. The asset can be almost anything: oil, wheat, gold, even a stock index. Say you agree today to buy 1,000 barrels of oil at $60 3 months out. Doesn't matter what oil's actually trading at when that day arrives, you're paying $60. Oil at $80 by then? Pleasant, you win, you bought cheap. Oil at $40? You lose, stuck paying above market. Why futures exist? Futures weren't invented by Wall Street, farmers invented them. In 1848, the Chicago Board of Trade opened to solve a very ordinary problem. A wheat farmer plants in spring, harvests in autumn, with no idea what price he'll get 6 months out. A flour mill has the opposite worry. They need wheat at a cost they can plan around. So the farmer sells a futures contract now, locking in his price. The mill buys it, locking in their cost. Both got the certainty they needed. That's the whole cast of any futures market. Hedgers, like our farmer and our mill, carry a real exposure and use futures to reduce it. Speculators have no wheat at all. They just take either side for a shot at profit. And without them, hedgers would wait days for a match. Before we go into the mechanics, there is a distinction you must understand: spot price versus future price. The spot price is what something costs right now. The futures price is what you agree to pay later, and those two numbers are almost never the same. The gap is called the cost of carry, basically the interest or storage cost of holding something over time. Put simply, the formula of futures price equals spot price plus the cost of carry. When futures trade above spot, that's contango, the normal state, since carrying costs build up the further out you go. Below spot, that's backwardation, the opposite case, usually a sign people want the asset right now and care less about future supply.
Now let's get into mechanics. Every contract has 4 parts: underlying asset, for example, S&P 500 index; contract size, for example, $50 times the index value; expiration month, for example, August 2026, and settlement, cash or physical delivery. Most stock index futures are cash settled. You take one of 2 sides. Go long and you're buying. You profit if price rises. Go short and you're selling first. You profit if price falls. Here's the part that changes everything. You don't pay full value up front. You post margin, usually 5 to 15% of the contract's value, so an $80,000 oil position might only need $7,000 down. That's over 10 times leverage. A 10% price move produces $8,000 profit or loss against that $7,000 deposit. Warning: leverage grows everything, both ways, equally. And what surprises many beginners is futures settle every single day, not just at the end. This means the exchange calculates your profit or loss based on that day's closing price and immediately credits or debits your account. If oil moved against you by $2 per barrel today, $2,000 leaves your account tonight, not at expiry, tonight. If account balance falls below a minimum balance and you get a margin call for more cash immediately, or the broker closes you out, there's no waiting it out. It settles with you daily, watching or not. Every contract has an expiry date. At expiry, one of 2 things happens. Physical settlement means the real asset shows up. Hold an oil contract to expiry and you're getting actual barrels delivered. Cash settlement just pays out the price difference. No asset moves. Most financial futures settle this way. Most traders never go near expiry. They close out early and walk away with whatever they made or lost. If you want to stay in the trade longer, you roll. close the expiring contract and open the same position further out. Caution, that's not free though. You're paying the spread between the 2 months, so it's a real cost, not an afterthought.
On any futures contract, two numbers get quoted: volume and open interest. Volume is just today's trades, resetting every session. Open interest is the total number of contracts still open market-wide, rising when new buyers and sellers pair up, falling when positions close. Rising prices with rising open interest usually means real new money is coming in. Rising prices with falling open interest often just means short sellers giving up and buying back. Now that you know the basics, let's trade futures for the first time. 1. Get approved. Futures need separate account approval beyond regular stock trading. Your broker checks your experience and risk tolerance first. 2. Fund it. Once approved, you deposit margin. A single oil contract might need $5,000 to $8,000 in margin. 3. Pick your contract and ticker. Oil is CL, the S&P 500 is ES or MES for the smaller micro version, which is the better starting point for beginners. You also choose the expiry month. Contracts are labeled by month and year. CLZ25 means crude oil, December 2025. 4. Place the order, long or short, market or limit, however many contracts. Click and you're in. 5. Watch it daily. Your account marks to market every close, so keep an eye on your margin level. 6. Close or roll. Before expiry, you close your position by taking the opposite side. If you went long, you sell. If you went short, you buy. The contracts cancel out, and your net profit or loss is settled. If you want to stay in the trade, you roll. Close the near expiry and open the next month's contract simultaneously. Enter, get marked daily, exit, or roll. That's the whole cycle. Here are common trading strategies. Directional trading is simplest. Think price goes up, go long. Down, go short. Hedging, what our farmer did, shorts a futures position to offset a loss elsewhere. A calendar spread bets on the price gap between 2 expiry months rather than direction, which tends to be calmer. And arbitrage keeps the system honest. If the actual futures price diverges from the theoretical fair value, buy whichever side is cheap and sell whichever side is expensive. And that pressure drags the price back toward where it should be. There's one more piece of this that most retail traders never fully appreciate: time itself. Most people think the market opens at 9:30 a.m. and closes at 4 p.m. in New York. That is a retail illusion. The futures market trades 23 hours a day, 5 days a week. When the physical stock market is locked behind closed doors, algorithms, hedge funds, and foreign banks are fighting a silent war in the futures market. If a war breaks out in the Middle East at 2 a.m. New York time, the stock market can't react, but the futures market violently crashes instantly. This is why the market gaps down. When the opening bell finally rings at 9:30 a.m. for the retail public, the damage has already been priced in. If you hold a futures contract overnight, you are leaving your net worth exposed in a dark room with the most ruthless institutional algorithms on the planet. Be honest with yourself about the downside. The same leverage that can double your account can wipe it out. A small move against you can erase your entire deposit, and you can end up owing your broker more than you put in. Futures also trade nearly around the clock, so prices can gap overnight on a single piece of news while you're asleep, long before the stock market even opens. Paper trade first. Know your margin before you place an order. Risk only 1 or 2% of your account per trade. Always use a stop loss and start with micro contracts, 1/10 the size, so your mistakes are too. Now you have every piece you need for that day. In early 2020, COVID shut the world down almost overnight. Oil demand collapsed, but wells can't just switch off. Supply kept coming while nobody needed it. Storage tanks filled, pipelines filled. By April, there was barely anywhere left in the US to put more oil. The May contract was expiring the next morning. Hold it, and you're legally on the hook for real barrels delivered to Cushing, Oklahoma. Nobody wanted them. There was nowhere to put them. You know the spot price was already falling, and why cost of carry meant nothing once nobody would take oil at any price. You know expiry meant real barrels with nowhere to go, and that mark-to-market meant those losses were piling up hour by hour, with no way to just wait it out. Traders sold to anyone who'd take the contract off their hands. The price fell through zero and kept falling. bottoming at -$37.63. At that price, someone would pay you $37,000 just to take 1,000 barrels away. It wasn't chaos. It was a futures market doing exactly what it's built to do, pricing reality with brutal efficiency. No matter how strange the number looked, you'll probably never trade a futures contract yourself, but the petrol in your car, the airfare you booked months ago, the bread on your table, all shaped upstream by futures markets pricing things that haven't happened yet. Futures exist to answer one question: how do you plan for a price you don't know yet? If this made futures click, subscribe. I'll see you in the next one.